Robschild, no investment advice. Welcome to the show where we view financial markets using technicals, macro, Benjamin Graham's investment philosophy, and of course, crystal ball gazing. Today is Wednesday, September 25th, 2024. Today's episode, I want to start by bringing up the idea that I have that U.S. stocks are flabbergastingly expensive and optimistic. And I'm not just talking about the Mag 7. A lot of times people have been saying a lot lately, well, if you take those 7 out of the S&P 500, the S&P 500 only has a PE ratio of 18 or something like that. When I look around at individual stocks, I'm not seeing cheap anything anywhere. Recently, I took a little deeper dive into realty income, to check out what's going on with real estate. Is real estate maybe cheap right now? No, the PE ratio is 60 right now, which is historically very, very high for that company. Well, what about Walmart? Again, just historically high PE ratio. The amount of money they're making doesn't constitute their price at all. ExxonMobil, same thing. It's not, the numbers, they don't make sense to me. And again, I'm not just talking about the Mag 7. I've been trying to understand, why? What is making these so expensive for their current PE ratios? One person I heard recently talking about, it's the forward guidance. So that's like what the company is telling the public, hey, we think we're going to make this amount of money over the next year. And so forward PEs are lower because companies are saying, yeah, we're going to make tons and tons of money moving forward. Now, the best way I can describe what's going on here is that the market is not taking forward guidance with a grain of salt. If anything, the market seems to be maybe even overestimating what the companies themselves are saying. And I just have to say that, if you're managing a company, of course you're going to be reporting the most optimistic possible numbers going into the future. If you're not reporting that and you're managing a company, you have no business running a company. Companies benefit from having a higher stock price. It helps them borrow more money. It helps them make more money. To use forward guidance as like, oh yeah, this is like helping my bullish case here. That's something I think is something to be very cautious of. And to me, this bullishness is bullish, which is why I bought more HYG Puts today. Specifically, I got some comments asking, what's the strike? What's the date? For a while, I've been kind of toying with little tiny pieces of money, like pieces of the portfolio, like a week out, 2 weeks out, next month. And the micromanagement is just driving me crazy. So I just, I'm not getting as many contracts, obviously, because the premium is a lot higher when you reach out this far. But I used 1.5% of my portfolio today to get HYG Puts strike price 75 for the September 2025 contract. So I'll explain my idea with this. Now, if I lose 1.5% of my whole portfolio, is that going to kill me? No. If I put 100% of my portfolio in something like this, it's like, I'm just, on the bearish side, you have to be careful. You have to, on the long side, you can take much bigger risk because generally things go up in price. But when you're doing bearish positions, you really have to be very careful with your position size. And I've talked about that before. I just wanted to mention it again. So to do a quick explanation of these contracts, these 2 lines you see on the screen are this is the date and the strike price right here. So all that has to happen is that this chart, that green bar right there, it needs to go down below this white line for the contracts to make money. Now, As long as they're below the white line before the orange line, then, I've won the game. I've made a lot of money with those contracts. And the sooner it gets below the white line, the more premium will be on those contracts. And I'll be selling them. I'm not exercising them. I'll just sell them. This is my way of getting leverage shorting this market, the HYG. Now, this current view only goes back to 2008. I want to bring up another chart, but before I do that, so as you can see, just on this chart alone, you can see in the financial crisis, we got all the way down to $62 a share, and then in the more recent COVID dip, we got down to 67, and then even more recently, throughout 2022, we were around 70. And as I've explained in other shows, there's multiple ways for HYG to drop below 75. One way is simply for long rates to go up. If the economy really is peachy and everything is fine, well, what happens? Bond yields go up. And what happens when bond yields go up? The value of bonds goes down. And along with that, so the value of all bonds goes down. So that already pushes it down, perhaps back down into this level where credit spreads were not super wide down here. It was simply that yields were higher. So if everything's fine, then yields should be going up and the value of this should go down. Not only that, when yields go up, spreads tend to widen at least a little bit. They can't really contract very much from here. As you've seen in previous shows, junk bonds right now only have about a 3% credit spread between them and treasuries. So they can't really get much tighter here. They can get a little bit tighter. They have historically, but I digress. The point is that when yields go up, if credit spreads widen, then this also pushes this down even further lower. Now you might say to me, well, Robschild, it doesn't get below this white line very often. Look, in 2008, it only went down there. So you must be very pessimistic to think that, it will necessarily dip down here. And then, in 2020 again, that was a crisis. Like, how are you guaranteed for that to happen? Well, again, in 2022, we were sitting under this line for like a year. So I don't think it's unreasonable to guess that we can easily get below this line again. There's a few more pieces to this that I need to share. So this is HYT. It's very similar to HYG. It's also a junk bond fund. And the reason I bring it up is only because this fund goes back to 2004. Now, in 2004, this fund was valued higher here than it is today. So you might assume, oh, well, bond yields must have been higher. Well, hold on. Actually, in 2004, bond yields were pretty much exactly where they are today, around the 4% range. This is the 10-year note. Today, we're about in that same range. So then why were junk bonds so much higher then? Well, Robschild, that must mean that credit spreads were like way tighter. They weren't. They can't get much tighter. The reason is because, as time progresses, a certain number of these bonds actually become worth nothing. That's why they have a higher yield. It's lower credit, so there's a greater chance of bankruptcy. There's a greater chance of default on these bonds. And as pieces of HYG default as they go bankrupt, this over time loses value automatically. That's the principal amount of these things. And so as you can see, in 2004, we generally are always on a trajectory downward with the value of junk bonds, even when rates are around the same level. Just in case you don't believe me about the spread, in 2004, as you can see, we were around a 4% junk bond spread. And so if anything, the value should be actually lower in 2004, but it was higher, again, because of the fact that a lot of these bonds will go bankrupt over time. So yeah, no more micromanaging HYG puts in the short term. I'm, just going to sit on these for a while, not worry about it. I'll sleep better at night. Anyway, moving on. Tomorrow we have the Thursday GDP second revision, quarter two. The initial was 2.8. It revised up to 3%. If it's revised back down, that could really rock markets. If it stays the same, then I guess everything's peachy. I don't know, but we'll get to our daily reminders in a second. Friday comes out the PCE, the Fed favorite inflation gauge. This really could affect the Fed funds futures, as I've been talking about. We are now priced to have 3 cuts still throughout the rest of this year, while the dot plot said only 2. The market says, nope, it's 3. So we'll see how PCE affects the Fed funds futures, see if that affects anything. And then next Friday is a real big report, the unemployment rate. Daily reminders, obligatory. These are things that I think are immensely important to not forget. We had the 2-year, 10-year Treasury yield curve inverted for over 2 years, reversion on September 6th. Last time this happened was right before the Great Depression, suggesting we might be headed into another depression. Somme rule was just triggered. Unemployment has been going up at an unsustainable rate. This was triggered in July of 2024. This usually says that the recession has actually already started. The S&P 500 is at a PE ratio of 30 without even having any major earnings contraction, suggesting that it is extremely expensive right now. Rate cutting cycle just began with a strong 50 basis point cut on the 18th. This says that the Fed is scared. They might be behind the curve here. The Fed funds futures is also saying we have another double cut plus one more 25 basis cut left for this year. I wanted to add to this daily reminders that the 3-month 10-year is still inverted, and this piece of it is simply emphasizing the fact that the Fed, even though we've been inverted across the yield curve for over 2 years, the Fed is still strangling the economy. We've loosened our grip a little bit. But until the 3-month 10-year uninverts, the Fed is actually restricting rates right now. The Fed funds rate is currently above the inflation rate. That's restrictive to begin with, and it's above the rest of the curve, which is very restrictive. It's still saying slow down market. This is all while the Fed is saying on the other side of their mouth, oh, we don't want the labor market to have any further weakness, so that's why we're cutting. Okay. And yet you're still strangling the economy. So interesting dynamic going on there. My crystal ball reading is that there is a market crash coming, big bear market coming. It would make sense for 1.5 million reasons. I'm also of the opinion that the Fed won't cut fast enough to save the economy, because when you have the amount of debt the U.S. has with a decent amount of fiscal dominance going on, the hiking cycle didn't slow down inflation very fast, and so cuts will not be as effective either as the economy continues to slow down, as everything is screaming that this is happening here. On to some more charts on a shorter term basis, looking at HYG. I said that, it looked like we have a bull flag. We're still very comfortably, beautifully in this flag. I can't imagine how this fund can keep going up here. As it is, Treasury bonds are going down in price right now. For this to flag like this and break out higher, it's nearly impossible for this to keep going up here. It's a matter of like trying to fight gravity or something, as credit spreads can only get so tight. So I am guessing that this is actually flagging and will break to the downside. This is the S&P 500, SPX. To me, this market, we're obviously basically at all-time highs. The crystal ball rating I'm getting is Mr. Market being shot out of a cannon, looking straight up at the sky, thinking that he's just going to keep going up forever here, while reality says that maybe that might not be the case. Nothing's changed in the NASDAQ triple Qs either. These tiny little candles, just like it's almost like a little weekly doji here, after I gap up. This is like pretty clear to me that this is a reversal signal. I still think that there's a head and shoulders top here that should break down to the downside, taking a lot of the other markets with it, especially the S&P 500. If you've been following the show for a while, you know that, I tried, it was for like a month. I kept seeing new patterns develop on silver, and I was sure that now it's looking bearish, and now it's looking bullish. I don't trust the silver chart with at all anymore, but I can't help watch it and just see the patterns that are playing out here. And we have a bull flag here developing on silver, suggesting that silver may continue higher here. But as I said, silver seems to be, to me, in my experience, to be one of these markets that purposefully tries to trick you. Like, it literally makes like a perfect pattern that like 80% of the time it should go that way, and then it just goes the other way, and then it does it again and again and again. I don't like Mr. Silver. I'll definitely get into silver if it gets, $20 range, sub $20 range. That's cheap enough. Right now, $30 range. Have fun, Mr. Market. Again, I don't always bring this up. I've been saying this a lot, but the October VIX futures contract is still elevated above the next 2 months. The way I see it is the price of the S&P 500 is in disagreement with this market here. There's more professionals in VIX futures, obviously, than in just the value of the S&P 500. I think there is danger incoming very quickly. TLT, my favorite place to be. Otherwise, why would I have 55% of my portfolio in this? I don't know, it's probably gone down to 53 now after this run. But we actually broke below this little trend line here. So it looks like it might go down to the downside for a little bit, or maybe it's a fake out to the downside and it'll come back. I don't know. I don't care. I'm holding this as an investment, but yeah, we could see a little weakness here. If I see further weaker data in the economy, I may go as much as 75% of my portfolio in long treasury bonds. The only thing really holding me back from that right now is that the unemployment rate not crazy high yet, even though the SOM roll's been triggered. To go full, I can't say the R word, in treasury bonds, I'm going to have to see unemployment go higher. Initial jobless claims really go higher. We got to see some more evidence that we really are here. I see it coming, but I'm not the only one that's seeing it coming. Oil, big move down today. I mentioned recently, yesterday, how with this hurricane coming, plus with the Chinese, the supposed good news on China coming out all at the same time, well, oil should be going to the moon here, right? I didn't even mention what's going on in the Middle East. I mean, geez, when there's chaos in the Middle East, the risk of oil shocks is a lot higher, and so that normally would be like oil to the moon. Oil's not going to the moon, folks. It dropped today a lot. Yields tend, by the way, long treasury bonds tend to follow oil. Bond yields going up and oil going down on the same day, that's a mismatch. I believe that the yields will be should follow oil here. I mean, obviously I'm bullish on treasury bonds. So I don't know, maybe I have a little bit of bias. I really try my best to not have bias, and hopefulness. When it comes to reading markets, it's really important to just have a cool head, realize, understand how you can be wrong, be okay with being wrong as well, by the way. I don't think I'm wrong about this. Oil is another one of these. It's like, it's a real market. It's like, this price is the reality of the situation. Oil, this is a big drop to the downside today. All with a hurricane coming in, all with, supposed bullish news in China. I mean, oil is screaming slowdown here. Speaking of China, KWEB, I have like 11 or 12% of my portfolio in this now since it skyrocketed. We dropped back a little bit today, but after a huge gap up like this, I would not be surprised to see this really go higher here. If this was going to be a blow off top, I would expect a much larger move down today, and we didn't get that. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.